do they have a point? Prices are going to increase because inflation rate is coming down, but there's still a lot of inflation in the U.S. economy.
So I actually think that the core point of what the president was saying is right on the economics. What we've seen over the past 2 years is a big bump in inflation where prices rose very, very rapidly. And that was really coinciding with a bunch of supply chain shocks in the economy and corporate concentration that allowed a whole bunch of corporations to raise prices well above the costs of making the goods at the expense of consumers. And we see that from earnings calls with corporate CEOs talking about how the inflationary environment was giving them cover to raise profits by raising prices. And those prices can come back down. What's supposed to happen, ideally, is as supply shocks ebb, more folks enter the market, bring supply online, prices start to come down in the sectors where they're really driven by these excess corporate profits.
So you think a lot of this has to do with the unwinding of the supply shock and less so inflation?
I think it's important to see those two things as going hand in hand. And actually, I'm kind of puzzled by the way that Chairman Powell is talking about inflation. We don't really see a change from the way that he was talking about inflation a year ago, even though we've really seen that the inflation dynamics have not been what you would classically predict of you see inflation, you need to lower demand, you need to, put a brake on the job market because wages are driving inflation. Wages have not been driving inflation. And in fact, what we've seen is the Fed pursued aggressive rate hikes. Inflation did start to come down very quickly, but it started to come down before those lagged effects that Chairman Powell was talking about. And it came down in the context of falling unemployment that's remained below 4% for 22 months now, which is a historic level. And last quarter, we saw 5.2% GDP growth. That story is not consistent with a story of there was a lot of excess demand and the Fed stepped in and that brought down inflation. And we should really, keep going on that path. It's consistent with a story that we had a bunch of transitory supply shocks. They lasted longer than we thought, but we were coming out of a global pandemic. I mean, there was a lot of strange stuff going on in the supply chain. And as those supply pressures are easing, you're seeing inflation drop.
So let's push this a little bit further here, Katie. Maybe we'll try to get inside Jay Powell's head for a moment. Let's listen to what he said today first on the outlook for rate cuts, and then we'll have you respond.
It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease. We are prepared to tighten policy further if it becomes appropriate to do so.
Katie, I wonder your take on this, because there is a thought that he has to say certain things and keep the market on edge for another potential rate hike. But it sounds like not only don't you want to see another rate hike, we don't really think he's going to do that here, correct? If you're going to preserve the soft landing, don't you need to wait to see these lag effects start to kick in and see where we are in the middle of next year?
I mean, I think it would be a big mistake for there to be another rate hike. I think that it's time for the Fed to start asking whether they should be considering bringing interest rates back down to whatever they think the long-term sustainable rate is. We saw CPI come in at 0% last month. And so the idea that we should wait to see whether the labor market slows further, wages stop growing, and we get down to 2% before we consider easing, I think is a real misunderstanding of what has actually happened over the past year and a half. And again, it relies on a theory of how rate cuts affected inflation that has not been consistent with the data over the last year.
What do you make of the fact that Americans are just not feeling it?
I think that's a really good question. And I think too often we sort of say, well, but the numbers say this. Why aren't people happy? The fact of the matter is prices are high. And I think that's one of the things that the president was getting at with his tweet is, we economists like to talk about inflation, which is the rate and change in prices. But even just as an ordinary person, when I go to the grocery store, I feel like things are really expensive, right? And we can't erase that experience from people. I also think that people understand that corporations have been raking in these record profits and could afford to share some of that back to consumers or with their workers. And so I think there's a lot of frustration. The other piece is we have seen wage growth outpacing inflation, but that's been relatively new over the course of the recovery. And, it's on the back of 30, 40 years of stagnant wage growth and growing productivity that was not shared with workers. And so I think another piece is that people aren't ready to just go back to the status quo after the pandemic.
So is this the soft landing?
Again, I think that the soft landing metaphor makes us think that the Fed is in the pilot seat of an airplane and they're carefully titrating the fuel. And I think that that's just not how things have been working. And so we need to be really circumspect about just continuing down the same path with the same theory when it doesn't really seem to fit the data.
So you think the Fed should almost be done? And Powell was trying to make a point today that, well, hold on, the market, who also, I think, potentially agrees with you that maybe he should be done. We can actually see some cuts at some point. So the market, though, responded by doubling down today. Do you think next year, and I find this fascinating because next year's an election year, that we could see the Fed cut into November?
I think that we're going to know more about what the Fed is planning for next year at the FOMC meeting this December, both because we'll see what they do with rates, but also because they're going to release new economic projections. I think most people do anticipate that there will start to be some cuts next year. Timing is uncertain. As Joe sort of mentioned, there is this sense that the Fed chair has to talk tough, which I think makes it difficult to read the tea leaves sometimes. But the other piece is we think a lot about the effect of interest rates on price levels and on wages and the job market. But we need to think more about the actual direct effects of interest rates on household budgets and on the price of things that people really care about. So I think the really big example of this is housing, where it is true that housing price inflation has come down slightly, but at the same time, actual housing is less affordable because most people don't pay for their houses in cash. They pay with a mortgage, and mortgage interest rates have more than doubled. And so people are really seeing that that doesn't show up as inflation, but I know that I couldn't afford the house that I live in now at today's mortgage rates.
Well, I was talking to my parents recently, and I found out they bought our house for $47,000. It's very difficult for the younger generation to get on the housing property ladder.
And those people actually are then stuck in the rental market longer, which drives up rental prices for everyone else. And what the Fed has done with higher interest rates is stop housing construction. That's not going to help with housing prices. We have a huge supply shortage. So that's going to start being a problem sooner than later.